Hey, my name is Mike Bishop. I'm a syndication professional. I specialize in raising capital, and I'm also a high-tech professional. And you can catch me on the Jesse T Show.
Mike Bishop, welcome to the Jesse T Show, brother.
Hey, Jesse, thanks for having me, man.
Yeah, man, it's been a pleasure. How we connected, just for some context for the listeners and the viewers, is a gentleman by the name of Todd Armstrong. Todd Armstrong has become a powerful force in my life for podcasting and for some business. And I know he's helping you out as well. How did you connect with Todd?
I was connected to Todd through my business and personal and professional coach. He had worked with Todd's partner, Christopher Dedayan, and they connected me because I had expressed to my coach that I wanted to start getting on some podcasts and sharing some of my knowledge and connecting with folks like you. So they connected us, and Todd and I got the opportunity to chat, and it was a perfect mesh. We got along both personally and professionally, and we decided to work together.
That's beautiful. Yeah, he's a great human being. I tend to find people to do life and business with that are heart-centric. He's one of those guys. He's also a huge SEC football fan, which makes for good conversation. He's super competitive, super great guy, family guy. And you mentioned Chris Dedayan. I've had Chris Dedayan on the podcast before too. Another great guy. Again, good people know good people. So it's good to know that you're in that circle. So for the listeners, if you could, just give us a little color and context as to who you are and what you do.
Yeah, absolutely. My name is Mike Bishop. I daylight, quote unquote, I like to say daylight as a high-tech professional. Anybody here who's listening is familiar with tech. I'm a site reliability engineer at Salesforce. And then I also run a business in the syndication space where I specialize in raising capital and investor relations. And for those that's not ringing a bell, I essentially help folks identify opportunities to invest in commercial real estate. So, multifamily, self-storage, mobile home parks. And then I serve as their point of contact through the project lifecycle. So, helping you identify helping you identify opportunities, and then helping you actually fund and get through that process. And then your point of contact for any questions, updates on project status, all those things through the lifecycle. So.
And what drew you to that industry? Because I know that you're in tech right now is the daylight side, but the moonlighting is the syndication. And I'm familiar with that industry, and we could dive into some of the particulars. But what drew you to it? What got you excited about it? Did you become an investor yourself? Did you get hooked? Like, what was the impetus for you to start with that trajectory?
Yeah, for sure. So as far back as I can remember, I've had a really strong passion for personal finance and for investing and, securing your future, family legacy, all that stuff. That dates back to probably elementary school, honestly. And then, when I graduated college, I took a job in tech. That's just kind of the path that my degree took me down, and my connections kind of landed me in that spot. But I took that job and I moved to Austin. I met some folks that were doing real estate, and they kind of showed me the power, the wealth building power, and the financial freedom power of real estate. So I jumped in, pretty shortly after graduating. I bought a house in Austin. With the intention to turn it into a rental property, because that's what these folks were doing, and that I had talked to. But it didn't take me very long to realize that I wasn't going to be able to scale that the way that I wanted to scale that, the capital requirements, and not to mention Austin was just a crazy hot market. And I was really early on in my career, actually, at that point. And frankly, I just didn't have the capital to scale the way I wanted to. So I started exploring other avenues of real estate after realizing the power that real estate has. And kind of started talking to anybody who would meet with me, offering coffee, lunch, to just anybody who would share their knowledge. And that's when I ran into the person who's my mentor now and learned about what we call real estate syndication. Through this process, I pretty quickly realized that this is combining the power of real estate with my passion for personal finance and investing and, securing your financial future. And it took me all of 30 minutes to decide, once I really learned what this was, and once I met with my now mentor, this is what I want to do, So I jumped in, I started the Bishop Investing Group pretty shortly after that. And within a couple months of forming my LLC, I was on my first deal. And it's been a crazy, but really exciting and really awesome ride since then.
I want to talk about the trajectory, the journey of your first deal and then onwards, but a couple things first. So for For Austin, number one, I'm a huge fan of Austin. I love Austin. I love the scene down there. There's this budding entrepreneur tech. A lot of people that are I'm in the spirituality. A lot of people that are spiritual down there, and it's like a lot of people that are in the health and wellness. So it's like my mecca in the United States for people that are in the business, health and wellness, and spirituality. So Austin has one of the places in the world that has my heart. And as far as syndication goes, talk about real estate and real estate. I was in finance for 11 years, and you're investing in finance now. And real estate is the number one way that people make wealth in this lifetime. People look to the stock market, they look to Bitcoin, they look to alternative investments, they look to precious metals, and some people can, quote unquote, like pun intended, strike gold, but most people don't. And most people are chasing returns on the market 6 or 7%, but they're also getting fees that are eating into that, and they're not being wise with their money. So a lot of people in the world have actually built their wealth through real estate. And whether it's primary homes for personal people, whether it's investment properties, Airbnbs, whether it's syndication like what you do, I've been intrigued by syndication because I know the power of it. I know the mass, the force multiplication that you can have with multiple properties, multiple units. Because I've been in real estate as an individual investor, and I've done like fix and flips, going to be doing some buy and hold type stuff. But for me, I realized the slow burn that it is. If you buy 1 second property and it goes into your portfolio, but now you have like maybe a second mortgage if you haven't paid it off, and you're hoping that your tenants are good, and you got to manage that, and you're hoping stuff doesn't break down in the house, and maybe you hire a management company. Like there's a lot more to it than people realize. So it sounds like you had that experience. You bought this other home, or you had this other home in Austin, but you learned pretty quickly that wasn't your jam. What was it that caught your eye or helped you to switch from that mentality of maybe I'll buy a few properties, collect a few rents, to now getting into syndication with dozens of properties, mobile homes, all these different things? What was that switch for you?
There was a couple things to it, really. I realized with syndication out, I can help other people. With buying my own single family, small multis, you can help other people and partner up with other people to a degree. But with syndication and the route that I specifically took in syndication, being a capital raiser and focusing on investor relations side, I get to help a ton of people. So like I said earlier, that was kind of a passion for me. So that really drew me in. And then just the passiveness of it. So for those that are not familiar with the syndication model, the simplest I can put it is it's a pooling of resources from a bunch of different parties to get something done. So as a passive investor, or the folks that I help invest in these deals, it's about as passive as it gets. The most work you're doing is vetting the operator up front. And then you basically sit back and collect checks. So I've heard from so many people that they're just done with the single family homes, they're done with the small multis, they're really really busy in their W-2 or their business or whatever it is, and they just don't have time for real estate, but they want to take advantage of the income producing and wealth building powers of real estate. And syndication accomplishes all those things more than probably any asset class that I've ran across to date. So I would say it's those two things that drew me that way.
Can you talk a little bit about that? Kind of caught my ear, and I'm assuming people that are listening and watching will want to know about this too. The word passive income can mean so many things. And a lot of times you have these snake oil salesmen selling you a dream. A lot of them are like online marketers and like, buy my course and in 60 days you can do X, Y, Z. And like, it never happens. And they're taking videos of themselves laying on some sand mound in like a parking lot in Philadelphia, but telling you they're in like the Bahamas. It's just a sham. Right. But I know I've seen personally through real estate, through syndication, through other people that do it, that are creating massive wealth, massive abundance for themselves and other people like you're mentioning. And to your point, you're helping multiple people. It's almost like a mutual fund for real estate where you have a pool of investors coming together for like a common goal to make money together and to build. Even I interviewed a guy who's a syndication guy many episodes ago, and he's helping to like give back to the community through his syndication deals, and he's helping to raise awareness, and he's doing a lot to give back. And so for you, it sounds like you were attracted to that, but even to more the investment opportunity and the wealth building. What are some of the things that you've seen, either primarily yourself through your coaches that you have, or through your clients, that they've been able to amass with this strategy, essentially, in terms of wealth or opportunity?
I mean, the opportunity is pretty endless because, like I said, you're pooling resources and you're working with a lot of different parties. So just the connections alone that you establish through syndications, and from the investment perspective, a passive investor LP, we call it, might be slightly different just because you're looking for a passive.
Is that limited partner for the listeners?
Yeah, correct.
Okay.
Limited partner. In a syndication model, there's a general partner, which is the folks actually operating the deal, and a limited partner who are those putting up the money, and they're getting a majority share of the profits for
Okay.
that reason. So from that perspective, there's a ton of opportunity to go out and make connections. And even as an LP, I've seen a lot of folks start as an LP to get into the syndication space and start to make those connections because, otherwise, just like anything else, there can be barriers to entry. It can be hard to get started. So I've seen folks leverage the LP position as a way to start getting involved there. Now, in terms of the actual wealth building of this, there's a lot of different ways to look at it, right? So depending on what your position is, but as the LP specifically, there's two ways. There's, typically these deals cash flow pretty strongly compared to a lot of other asset classes. And
can you give us an illustration, not a guarantee, but an illustration of maybe a case study or something that you've seen?
Yeah, for sure. I mean, so, you might be looking at on the lower end of 4% per year and on the higher end 10% per year. But a lot of times syndication models are baked into where you have a preferred return of like 7, 8, 9, 10%, depending on which investment class you go into. And what a preferred return means is that essentially you are first in line for returns, typically behind, like the loan.
Common stockholders get the last, but the preferred stockholders get the first. Yeah, it's similar to that.
Yeah, exactly. And what's beautiful about that too is an operator that you would prefer to work with. Not all operators do it this way, but we look for that in our partners. Is it's compound and accumulative. So, like, say I said, earlier I said on the low end you might be looking at 4% cash on cash. If you have an 8% preferred return on that deal, that means we still owe you 4% from what we missed in that year one 4% distribution. If there's an 8%, that 4% rolls over. So in year two, theoretically, we owe you 12%, and that would get caught up, at a sale. So theoretically, let's say you have a hold for 3 years with an 8% preferred return, and every single year there's 0% return on that. At the sale, at the end of 3 years, we owe you 24% before anything happens. 24% on your money.
Wow.
So
and how does that back up in terms of, the world ends, worst case scenario, prices plummet. We're in a ridiculous market now for so many reasons, but let's say like the world crashes and, there's not, is there a way to guarantee that 24% in that illustration per person that's in the fund, so to speak, per LP, if the funds aren't there, like if the real estate somehow plummets in value or the deal plummets, like you said, at the end of the 3 years, if there's a payout, what's kind of like, from what you've seen, what's the guarantees if there are any?
Yeah, I mean, so there's risk in any asset class.
For sure.
We all know that there's risk everywhere, and show me an asset class that has a 100% guarantee and I'll put all my money there. It's rare and you just can't find it. A preferred return is modeled to be as close as you could get to a guarantee. So if the returns are available, you're getting it. So say there's an 8% preferred return and there's only 6% total, all of the return is going to the limited partner.
Yep. And as far as the barrier to entry, you talked about, some people, I've heard numbers of like you put 50,000, you get in the club, so to speak, whatever the number is, 25,000. And then, I've heard payout strategies of quarterly. And like you said, it's the strategies that I've seen and I've heard personally, as someone who is a fiduciary and manages portfolios of investments for people on the stock side and the trading side. It's wild. It's wild, the opportunity there. So, I personally, as an investor, love real estate, and I love I don't sell products or services to people because I just give them advice on how to use their money, how to make their money, how to protect their money, and they pay me for that advice. But then I also manage their portfolios at like a TD or what's becoming Schwab now. But to say that, I know that the stock market is really not the most attractive place to be, even though that's the business I'm in. And I know that real estate can be one of the most attractive places to be. So in terms of people's barrier to entry, people that want to get into this investment, class and put this as part of their portfolio, or maybe it's their only portfolio, which, conversation for the time. What have you seen in terms of people, like how much they have to pay to get in? Do they have to be an accredited investor where they're making a couple $100,000 a year for X amount of years with their spouse, 300,000, whatever the numbers are? Are there accredited investors that have to be part of this? Can they come in with a certain amount of money? And like, how does someone get into this strategy?
Yeah, so that's a pretty deep topic. Generally speaking, you need to be an accredited investor. And what that means for those not familiar is $200,000 income per year for the past 2 years with the expectation to make the same this year. That's individually. Or 300,000 with a spouse, or $1 million net worth, excluding your primary residence. Now, I say generally you need to be an accredited investor because these deals can be structured in a way that allow non-accredited investors in. And typically, they want to see that those investors are at least sophisticated. But typically, if you're looking at these deals, you're a pretty sophisticated investor. You kind of know what you're doing. But the caveat there is it's a limited number of people that can come in when a deal is structured that way. It's limited to 35 non-accredited investors. So
right, and that's regulation through like FINRA, I believe, right? Like they limit it because of the sophisticated versus accredited. Like there's parameters of barriers to entry, essentially.
Exactly. Yeah, it's a parameter under Regulation D, 506B and C. You look that up, you'll kind of learn about that. So that 35 can be like a small majority of the investors coming to a deal if it's a larger one, or it could potentially be a large majority if it's a small raise. And then the other barrier to entry is, like you mentioned, there's typically a minimum on these, and those are generally set by the operator. And what I mean by that is I'm not the operator. We partner with the operators who go out and execute these deals. I'm just helping them raise capital for these deals and helping them manage their investor relations and helping these folks grow their money and earn some passive income. And those typically look like, I would say a comfortable baseline, you could say, is about 50,000. But sometimes we see a $25,000 mark, and then sometimes we have a little bit of wiggle room as we approach the end of the deal. Like, hey, we need X amount. We'll take 15, 20, whatever it is. But, it's not like the stock market where you can put a couple $100 in and let it ride. It's typically in the tens of thousands.
Well, it's kind of, you get what you pay for in life to a degree. And if you're playing a different game, like you said, the stock market, and you're putting in $100, few $100 a month, you're not going to expect huge returns because there's not a lot of volume to give back from. But once you start getting into those numbers of tens of thousands, hundreds of thousands, the returns can be better because there's just more money to be made for everybody. So I'm excited to hear about your first deal. Was it clunky? Was it hard? Was it easy? Was it smooth? And the progression from that first deal to the kind of deals that you're working today.
Yeah. So first deal, actually, we've been going through trying to sell that deal. Our operator has, and with the market right now, it's kind of hit some roadblocks. But I'll say in general, it really, really depends because, the same operator can have a super smooth deal. Same operator can then, 3 months later have a super bumpy, super rocky. And I say this on both ends of the spectrum, selling it or acquiring the asset. It can be a product of the market situation, where it's at geographically, who the seller is, what lender they're working with. There's so many things that really go into it. But generally speaking, all of the deals that we've been part of and that we've partnered with on with our partners have all gone fairly smoothly. And I'll give you like a brief example of our worst asset, or our rockiest, as you said.
Go for it, yeah.
So it was a 2-property portfolio in San Antonio. We love Texas. Austin, Dallas, Fort Worth, and San Antonio are all target markets between various different operators. And we had a couple of different problems there. One of the assets just for some reason had lease-up problems. And what I mean by that is the occupancy rate and this was a multifamily project. So it was 2 apartment complex assets, basically. And one of the properties had lease-up problems for whatever it is. That can be for various different reasons. It could just be, time of the year. It can be something that's specifically going on at the property that residents are not liking. It could be poor management. The operator took over from poor management, and they're really trying to kind of burn off all of that poor operations, if you will. So we had lease-up problems on one asset, and then on another asset there was a major water leak issue. And
oh, wow.
Our operator had to work with the city of San Antonio. There was a lot of back and forth from a legal perspective. Ended up costing a bunch of money on that front because they couldn't prove initially that it was the city of San Antonio's fault, but it was because they were doing a project and they were digging and they burst a pipeline or something. But before they determined that, it was a lot of working with plumbing companies to try to figure out what this was. Tens of thousands of dollars spent on this thing. So that was probably our clunkiest deal, to be honest with you. And we exited that, our operator, I should say, exited that late last year for a really nice solid return. So when you're seeing these monthly updates of like, here's the problems we're having this month, Here's our lease up problems. Here's the latest on this massive water leak at our property that's costing us, thousands of dollars every month. And then you sell it and you're like, these are really nice returns, especially compared to popular asset classes like the stock market or investing in a business. It's pretty reassuring that like, this is an awesome business model. You can have all those problems and still return really good money to investors.
It's wild. Yeah. And you touched on the market, and this is something that's been on people's minds for a while because, in terms of even just history, right? Looking at the stock market and being a student of the stock market to a degree and understanding cycles, it's generally every 10 years as an economy, the United States goes on what's called a bear run, which, for the listeners is just, we're doing well. We're people are happy, they're eating well, they're buying things, they're traveling, they're doing all the fun stuff. But then, generally we go anywhere from about 1.5 to 2 years after that 10-year bear run to a bull market or a recession. Yeah. And this is cyclical and it's needed. It's not anything that's bad. It's something that's predictive. It's over the last, 90, 100, whatever it's been years since the stock market was incepted in 1934. I could do the math if I wanted to. 1934. We've had these cycles and we've had these periods of highs and lows. But the really interesting thing that's happened over the last 2-3 years is we've had COVID. We've also had some changes in politics and some changes in geopolitical, ideas and what's going on in the world. We're in a very strange time in many ways. And one of the strange things is we are way overdue for a correction, and we are experiencing some serious inflation, and we're experiencing 10, 15, 20% prices above market, people paying for cash for residences, even on the personal side. Mm-hmm. All that to say, how do you feel about the market, and what trends are you seeing? And do you see a necessary correction coming, and how does that affect what you do?
Yeah. So I would say, from a personal standpoint, I generally have the mindset of the market always goes up. We're going to have corrections. We're going to go down.
Do you know who Dave Portnoy is? Just not to cut you off. Do you know Barstool Sports, Dave Portnoy?
Yeah.
Yeah. He went into investing and doing some trades himself. And his whole quote is that the market always goes up.
I've never heard that. That's funny because I'm fairly familiar with Barstool Sports and Dave Portnoy. I've never heard that. He
said stocks, like his joke, and he was actually he's crushing it for a while. And he was like, stocks always go up. And he was pissing off these traditional like financial planning pundits and like news anchors and stuff. But it's funny that you said that because he says the same exact thing.
Yeah. And I'll caveat that with saying that like my approach is generally just diversification, like especially in the stock market. Most of my stock market money goes to index funds and just let me average it out and let it ride. And then I'll do stuff like syndications and things on the side. Now, opposite of that, of course, there's some concern, with the interest rate environment, the way that it is, it kind of makes things tighter, but there's a lot of levers that these operators can pull during tough times like these. And on top of that, this is an asset class that's not generally directly or positively correlated with the stock market. In fact, you go look back at like 08, 09 crash, for example, and the delinquency rate on multifamily, meaning the amount of multifamily owners that defaulted on their loan, was incredibly low compared to single family homes and the way that the stock market performed in that time. So I look at it as we're not directly correlated. And we primarily focus on multifamily, which is a need. A lot of things that go down in the stock market are desires or wants or luxury goods, and this is not that. Yep. And also on top of that, what we focus on is the B asset class. So what I mean by that is there's generally like D, C, B, and A asset class. A is like brand new build, top finishes, looks really good, probably top dollar in the market. And then B is like still really solid, working class professionals, make decent money, looks nice, but there's some room for upgrades, right? So my point in saying that is during times of economic hardship, maybe people lose their jobs, those types of things, that there's going to remain a demand for B, because most of the time those B folks are keeping their jobs and they still have decent income. And then if anything, we're going to have A folks trickle down into B who want to stop paying that top dollar for rent. And then I mentioned earlier that there's levers that these operators can pull. And that's, of course, assuming that you're working with a conservative operator who's modeled in the potential for a market downturn during their hold period. And there's so many different levers you can pull. Like you can stop distributions in order to, stop investors from losing their hat.
Save money, yeah.
Why not save money and be able to make loan payment? This is like worst case scenario, right? be able to continue to make your loan payment and not be forced to sell in a really bad market because you can't make your loan payment. You can, say you go into the business model with a $6,000 renovation budget per unit on a 200 unit property. Shit hits the fan and you can lower that to, let's do $1,000. Let's do a $1,500 renovation and we're saving $4,000, $5,000 per unit in operating expenses. So those are two of we could sit here all day and talk about the levers that operators can build into their modeling. But that's the beauty of it, is that you have so many options before it's worst case. And honestly, from what I've seen, of course, this is no guarantee of what will happen in the future. But from what I've seen, worst case has been pause distributions for a little bit. And even before that, you can stop, for example, like you said, operators typically do quarterly or monthly distributions. Say you do monthly, which is very favorable among investors for good reason. You like seeing that
Cash
check
flow
come in every month. And, especially folks who are looking for current income as opposed to growth, that's a really nice feature.
Yep.
But say you're doing that, you hit times of economic hardship. Let's say, all right, let's move to quarterly. That gives us months in between to kind of assess where we're at with the asset, what the market's doing, what right now, for example, what the interest rate environment is doing and how that's impacting our cash flow or NOI. So there's a lot of things that operators can do before things really, really go south.
What's the general agreement time between investor, operator / syndication manager? I guess whatever the word is, but basically, what's the time? Is there like a 3-year expectation that they sign for that they get in returns for 3 years? Is it sliding scale? You could do it for 1 year, you could do it for 5 years. Is there a general time frame where people can basically get in as an investor and expect returns at whatever frequency?
It's a sliding scale, really. So one of the things actually that is one of those levers we can pull is most of the time the operators build in we can hold this indefinitely if we need to. We don't want to hit our target hold period of 3 years and we're in a terrible market and we're forced to sell because that's what the business plan said. So a lot of them will over exaggerate how long they say they're going to sell so they can kind of be flexible with whatever the market's doing at the time. But in general, you're going to see, I say that the average is about a 3 to 5 year hold. And you're going to see projections anywhere from a year to 7 years, typically on syndication model.
So, we were talking about trajectory of the market. And we're talking about, the growth and scale of your business. When you look at, your future in this business and what it's going to be able to do for your family, what it's going to be able to do for your personal life, for people that you're helping, where do you see the business going? And what are some of the bucket list things that you're going to try to accomplish through the business and what you're doing now?
Yeah, I mean, my primary goal right now is just to focus on helping people achieve their own sort of financial freedom. And when you achieve financial freedom, of course, you achieve other freedoms. You achieve freedom of location, you achieve freedom of association, meaning who you associate with and who you spend your time with. So for me, it really boils down to the freedoms that you can accomplish through this passive investing model, because you're not spending all your time sourcing deals, you're not spending all your time managing deals. You're not spending all your time trying to make money. I mean, theoretically, you're not going to invest in one deal and I'm going to sit on a beach somewhere in Hawaii. That's not going to work that way. But, it does help you get there faster. It does help you accomplish those things, especially if you have a fair amount of capital to put into these things. I've seen people where in a year or two, they can build up a pretty nice passive cash flow that's like a pretty nice yearly income. So my focus right now is just to help folks achieve freedom. And by helping other folks achieve freedom, I'm going to be able to achieve the same thing for myself. Of course, there's the financial aspect of this business and why I got into it. And that's what I'm looking for me and my family. We're big on kind of our tribe, if you will, and connecting with each other and being present in the moment together and spending time together. And while making money is nice and having that freedom of, the financial freedom of being able to do what you want.
Options. Yeah,
options for sure. But it's nothing if you don't have that time with your family. I'm not looking to, you could double my income, but if that meant taking 60% of my time away from my family, no thanks. So,
yep.
I'm looking for ways just like these investors are to buy time back or earn time back that you can spend time doing what's important to you. And to me, that's being with my family. So the beauty of this business is that I can do it when I want, where I want, from where I want. And I can also help who I want. So again, it goes back to those options, and it just gives flexibility not only for me but for the investors that I'm helping.
It's really interesting that you mentioned time. I was once upon a time, not too long ago, was writing a book, and I got about halfway through the book. It was called Happy Wealth, how to create, basically the time that you want to be able to do what you want is the idea of the whole book. And first couple chapters talk about time, talks about how time is the only commodity that we're never going to be able to make more of. We can't make more time. Being present is the most powerful way to live your life in the time that you have. And as far as that being a cliche, the present is a gift. It's the most true thing in the world. Like, we only live in the now. There's,
Yep.
We experience the past, we can't go back. We look to the future. And a lot of times when people do that, it creates anxiety because they're not being present. And so all we have is now. And when it comes to time, in terms of money, the one thing I've realized working with like a lot of high net worth individuals and people that have a lot of money, there's people that have a lot of money and they're rich. And there's people that have a lot of money and they have a lot of time and they are wealthy. And I think that's the difference, is being able to do what you want with your time, how you want, with who you want. So I couldn't agree more. Jumping into, you kind of segued nicely talking about family. Did want to talk about this because this is something that I'm huge into in terms of, taking a little bit of a left turn off of business, but big into spirituality, big into personal development, big into mindset, as you can see the little fish shark behind me. And this is kind of my ethos is growing through different seasons of life. And we had talked prior to doing this conversation about how correct me if I'm wrong, but aren't you and the missus getting into some sort of, like, you're building like some sort of retreat center or some sort of thing on the property where she's going to be doing maybe some Reiki or some other stuff? Did we talk about that?
Yeah, absolutely. So it's still kind of up in the air. We just closed on, we just came back to Indiana to get us a little bit, but primarily our 2-year-old boy, closer to his family. Her family's in this area and I'm in this area, the Chicago suburbs, that is, of Indiana. And we just closed on this, if you could see on the other side of me here, this beautiful 25-acre property with 15 acres nationally protected wetlands.
Congrats.
And part of the reason we purchased that, thank you, I appreciate it, is one way, of course, I'm living here, I'm working here, I'm doing things here right now. We keep cutting out. You're back. And also the option to create a retreat here. So we want to create a space for folks to get out and reconnect with nature, reconnect with themselves, reconnect with their loved ones. Not only retreat, but also if you want to hold events here where you do those types of things with other folks. And my wife is very into the spirituality aspect. I'm kind of trailing right behind her on that. And it's funny, she was just telling me last night that this property has allowed her to come more into her own than any other property might be able to, because she can go outside and we're surrounded by nothing except for trees and land and nature. And she doesn't have that pressure of like people watching, across the street or whatever. So, it's really helped both of us a lot. I think before we even got here, we knew we were big into reconnecting with nature and kind of harnessing that positive energy, if you will.
Oh yeah.
And it's just kind of reinforced those beliefs. And to go back to your initial question, though, yeah, we're looking at kind of putting a retreat here or something and kind of sharing this wealth with other people, because to me it really is a wealth to have this, especially if I drive a mile away from here, it's a town. There's a lot of stuff going on. There's cars everywhere. There's businesses. There's people, and to us, it really feels isolated out here. So we want to share that with people.
It sounds like the soul's calling from your wife and from you as well on your individual, but also joint spiritual journeys, that getting into nature was going to be healing for not only you, but the people that you touch, the people that come on these retreats or events. And I'll tell you, man, I've been steeped in my journey, my spiritual journey for many years now. And there's nothing like nature in all the ways, whether it's the ocean, whether it's the mountains, whether it's just in some deep tree area, you can literally walk in. And for people that want to experience this, you can go sit on top, like go hike a mountain. You can go, into nature and sit down and just be. And if you can just sit with that presence of, where you're at, you'll actually find a lot of insights that you're looking for. And you can even pose yourself just one question. This is something I do all the time. One of my modalities and that I use for growth and for healing is there's a mile high, not super big mountain in Georgia called Kennesaw Mountain that I live right down the street from. And I'll hike that alone or with friends. And when I get up there, I sit down on top of the mountain, take my shoes off, put my feet on the ground, and I'll either just sit there and just feel what's going on, or I'll ask one question and I'll throw the question out to the universe, so to speak, and I'll just see what comes back. And every single time I've done that, and every single time I've sat there and I was in nature, I've come down from that mountain a different human being. And so it's so powerful. If you get really deep into the science and even some of the woo-woos for people that really aren't into this stuff, but there's a frequency in nature that's almost the same as the frequency of love. And it's really wild to know that. So I'm excited that you're able to experience this.
Yeah, I honestly can't express what this has done for us. We've only been here for like 6 months. And it's just, you were talking about that just now. I was over here getting goosebumps because it's, we knew we liked nature, but we didn't know how much it really could impact your life and your mindset and progress in other areas of your life, to be honest with you. Because when you can leverage nature to teach yourself to really be present in the moment, like, for example, one of the things I like to do is just go out there, close my eyes, and try to hear all the different sounds I can.
That's beautiful.
When you're surrounded by 25 acres, it's like, unless you do this deliberately, you don't realize how many sounds there are and how much life and energy and all that is out there. And this really helps you ground yourself.
Yes.
And learn to be present. And when you can learn to be present and not focus on the past or the future and create those anxieties that are associated with that, it changes every other aspect of your life.
No question, man. And to that effect, it's really wild. It's had the very similar experience about a week ago with my girlfriend walking up, kind of saw a mountain, get to the top. There's some rock formations up there. We sit on the rocks back to back with our eyes closed. And we did exactly what you just said, which is listening to everything we could hear, whether that's our own breath, whether that's birds, whether that's crickets, whether that's people walking by, and just letting those things happen, keeping our eyes closed. And then eventually after we get to a certain point, opening our eyes, and then like the perspective that you have of being present, being grateful, which is really the biggest thing. It changes your life, man. So I'm glad that you're on that trajectory. And one last thing, in terms of anything that you're working on, anything that you want to plug, anything that you want to get out to the listeners or viewers, is there anything you want to talk about?
I would just say, if you have any questions about the way the syndication world works, or if you're interested in commercial real estate, feel free to reach out to me, because, I mentioned at the beginning of the show that I got into this to help people, and I truly, honestly meant that. You don't even need to, want to work with me or invest with our partners per se, but I'll help you however I can. And one of the other things that's very interesting too that I'll plug is we have this really cool, unique opportunity to do 1031s. If for folks who are not familiar with the 1031,
that's a beautiful thing. Tell people about that.
Yeah, it's essentially a tax deferral method. And I emphasize deferral because a lot of times people get 1031 confused with the tax avoidance. There is no tax avoidance. That's just
death and taxes, baby.
Uncle
that's all it's guaranteed.
Yeah, Uncle Sam's going to get his money one way or another. But it is a tax deferral, meaning you can take gains from something and you can grow those gains tax-free until ultimately you realize those gains.
Which you can actually die before you realize them, by the way. People can keep doing this. I've heard of people that, and I've never done it personally, so I don't know. I'm not steeped in it, but I've heard of people that continually just do this and stave off taxes, which means you're going to pass the buck to somebody else. But at the end of the day, you don't pay the taxes in your lifetime.
Yeah. So what it looks like at a high level is you sell some asset, and then you pass your funds through a third-party intermediary who holds it. You're not allowed to take control over those funds, and then you pass it through to a like-for-like investment. So you're selling a multifamily, you are investing right into a multifamily, and it has to be, there are ways around it, but it's very long.
Legal loopholes, and these are fine. Yeah.
Yeah, but I mean, I was going to say there's ways around having to do all or nothing, but generally you go all or nothing. So say you put 100 grand in and you're all in. Once you've sold your last property 150, you have to roll all 150 into the next project, just as an example. And it helps now, instead of, most people who are doing these deals are high income earners. So you're at a fairly high tax bracket. They're either high income earners or have a high net worth. So a $50,000 gain and you're in a 30% tax bracket, you can do the math there. So by 1031ing, you get to roll all 50,000 gains plus your initial 100 and now earn on 150 as opposed to earning on 130. Now you look at that at a bigger scale and it's more and more powerful.
Yes.
So we're working on a pretty cool program over here where we're helping folks 1031 deals or their own private deals into some of our deals. You might get like a John Doe who's in BFE, Idaho, for example, who's exiting let's say a strip mall. And they want to 1031 their money, but in BFE, Idaho, there's not a whole lot of opportunities for them to find a target project to 1031 their money into. So we're helping people like that 1031 their money into big multifamilies, self-storage, things like that in big markets or tertiary markets of big markets. And when I say big markets, Orlando, Dallas, Phoenix, Austin, San Antonio,
Yep.
The ones that are all hot, performing well. So that's a pretty cool, unique opportunity for anybody looking to benefit from the tax advantages of the 1031.
Yeah, man. And for people listening that may be newer to some of this terminology, tax deferral, reducing your tax liability so you pay less in taxes, but also, correct me if I'm wrong, from an immediate standpoint, you're also, let's say you roll this money into a new property and this property is cash flowing, you're still taking advantage of the cash flow. Is that correct? You don't have to worry.
Yes, yeah. So you get cash flow in the next deal. And then I'll also say, on the topic of tax advantages, there's a thing called depreciation and cost segregation studies in commercial real estate. And essentially what that means is you can speed up the depreciation of an asset for the life of the hold. So like our average hold is across the deals that we've exited so far with our operators is just under 3 years. And you could speed up the depreciation of that physical asset as opposed to like over, say, a 20-year loan. You could speed it up to 5, 10, whatever it is. And this is so beautiful. I can't emphasize it enough that those losses get passed through to the passive investor.
Yes.
And it can offset your gains in that deal. So as an easy example, you have $8,000, you invest $100,000, you get 8% preferred return. So your cash flow is $8,000 in that year. But the cost segregation study might pass through to that limited partner a $10,000 loss because of the accelerated depreciation. And now your passive income is negative $2,000.
It's beautiful.
So you don't have gains that you're paying taxes on because of a legal depreciation effort. And not only that, if you have other passive income in your portfolio, you can use that other $2,000 loss to offset other passive income. So the tax benefits here are just huge.
It's wild. It's amazing what the government has set up and the benefit of people that are doing these types of things, whether it's business owners, whether it's people that are in syndication that are just individuals or business owners as well. But there's so many legal loopholes that we could take advantage of that some people just don't even know that exist. And it's people like you that can educate people on not only, things that are powerful for them, but things that can actually change the trajectory of their life. So I appreciate the conversation, man. It's been very insightful. It's been very informative, even for me as someone, I'm a student of these types of things. So even if I'm going to be greedy as the first listener or viewer, I'm just saying thank you for all the information. And I'm looking forward to where our connection leads, because I know there's a lot in common and I'm looking forward to plugging in as we go along. But thank you so much for your conversation today, brother.
Yeah, man, thanks for having me. I appreciate it. Great conversation. Like you said, I'm super excited to see where our relationship goes. If I can help any of your listeners in any way at all, even if it was just this conversation, helping one person, that's a win.
That's it, brother. Thanks so much for being you. I'm Jesse. That's Mike. Catch us on the next episode of the Jesse T Show.